Coming up on the SBS On the Money podcast, interest rate cuts spur property price records. Donald Trump increases steel tariffs, what it means for shares, and a $14 billion mega merger. We'll tell you all about that and more next. Hello, everyone. It is Monday, the 2nd of June, 2025. The Australian share market closing lower today. The S&P ASX 200 down by about 0.25%. We'll have the details with Robert Talevski from Activam in a few moments. But first, low interest rates have contributed to another rise in home values to record levels. Cotality, which used to be called CoreLogic, says the national average rose 0.5% last month to be up 1.7% for the year, pushing the median to above $830,000. Now, capital city prices rose across the board. Sydney, for example, up by 0.5% to be above $1.2 million. And while Brisbane, Hobart and Perth rose by more than 0.6%, Darwin actually saw the biggest increase in May by percentage, up 1.6% as investors moved in. So for more, Rhayna Bosch spoke with Tim Lawless, the head of research at Cotality.
I think a lot of it has to do with falling interest rates. The fact that we started to see values rising once again in February, coinciding with the February rate cut, I don't think is that much of a coincidence, but probably more so than the actual, I suppose, improvement in serviceability or borrowing capacity. This is probably a lot more to do with just sentiment and the positive influence we see from lower interest rates on consumer attitudes.
Yeah, you mentioned some of the impacts there, and as you say, it doesn't make housing cheaper, right? It doesn't make housing more affordable. It just plays into borrowing capacity. So how concerned are you about what this will do in terms of Australians just taking on more debt?
Well, yeah, absolutely. You're right there. And the fact that we're seeing housing values rising once again, just on the monthly numbers, it's a $4,000 increase in the median dwelling value on that 0.5% increase nationally. The last 3 months, we've seen values rise about $11,000 on the median. So it does mean affordability is remaining a real challenge in the market. And you've got to admit, this is one of the key headwinds in the housing market, is simply that housing is quite unaffordable, particularly for first home buyers. So I think you'll find that's one of the factors that keeps a lid on price growth going forward. Even though we're expecting values to continue rising, I certainly don't expect to see another housing boom ahead of us.
Now, you mentioned sentiment there, but there are obviously some other factors at play, things like immigration, for instance. How much of an impact are they having?
Yeah, there are some downside factors here, like population growth is normalizing. That, of course, takes away from housing demand. We're also seeing household sizes becoming larger. That helps to de-amplify housing demand. Both of those factors probably more aligned with rental demand than purchasing demand in many ways. But then you've got something like household debt levels are still very much elevated. They're not quite at record highs. That was back in 2022. But household debt's not far off those record highs, which means lenders are generally still pretty cautious around lending on, say, high debt to income ratios or high loan to income ratios as well.
Looking at some of these figures, we see national house prices rising by 0.4% on the lowest end. And then there's places like Darwin that have seen a pretty significant gain. Can you talk us through why that's happened?
Yeah, Darwin's a really interesting one. And obviously it's a pretty small market, so there is some volatility to read through here. But the last 5 months has really been a story of Darwin moving into what looks to be a pretty decent growth trajectory after generally a period of weakness. In fact, Darwin's the one market where housing values are still below their 2016 highs, which you might recall was part of the, I suppose, the hangover of the mining boom. So for Darwin, it does look like this might be a growth trajectory that's very much influenced by investment. If you look at the ABS housing finance data, lending to investors is up about 55% over the past 12 months into Darwin. It's got a very high rental yield. It's extraordinarily affordable as well. But at the other end of the spectrum, yeah, you've got markets like Canberra that are generally still quite soft, although moving back into some level of growth. What's really, I suppose, dragging on Canberra's headline growth rates is the apartment sector, where supply levels in ACT apartments have generally been pretty forthcoming. They've been quite high. It's a great example of how additional supply can help to keep a lid on affordability challenges.
So where then, I guess the big question is, do you see things going? We've had analysts saying they're expecting a 6 to 10% rise in home values by the end of this year, if not early next year. Do you agree with that?
Yeah, I think it's probably somewhere around the lower end of that bound, but that's looking quite realistic to me, especially given that we're going to be seeing further rate cuts this year. At least that's the expectation for most economists. We're likely to see sentiment improving further from here. But like I was saying earlier before, there are still a lot of challenges and a lot of, I think, factors that'll keep a lid on price growth. So probably 6 to 8% would be my guess, but there's so many moving parts that I think forecasting anything at the moment is notoriously difficult.
That's Tim Lawless there from Cotality. Now, Market Day on the SBS On the Money podcast. To the Australian share market now, we've started the working week lower. The S&P ASX 200 down 0.24% to 8,414, although there were some big movers today. To tell us more about that and the rest of the market action, I spoke with Robert Talevski, the Managing Director at Activam Group. Robert, a bit of news out of the US over the weekend. Firstly, on the broader themes of tariffs. So last week, a US court blocked Donald Trump's reciprocal tariffs. But Donald Trump has pushed ahead with new tariffs for steel and aluminium anyway, up from 25% to 50%. Does the market think that tariffs will indeed be blocked?
Yeah, so markets are closely watching. While legal challenges are may slow implementation, Trump's persistence suggests tariffs will stick. Many investors see this as a sign of a longer tariff trend, which could mean higher input costs for US manufacturers and supply chain disruptions. Equity markets have mostly shrugged off the move so far, but bond markets are eyeing inflation risks if these tariffs push up prices. The key takeaway, even if some tariffs are blocked, the broader shift towards protectionism under Trump remains a market driver.
These new steel tariffs that I mentioned a few moments ago from 25 to 50%, how has that impacted local stocks? Because while some have been hit, the likes of Bluescope the shares in that company have surged. Why?
Yeah, so Trump's move to double US steel tariffs at 50% has seen ripples through the global markets. But for Bluescope Steel, it's been a windfall. Shares in Bluescope surged up 9.5%, reaching a 3-month high, as investors anticipate higher US steel prices benefiting its American operations, with North America accounting for 42% of Bluescope's earnings. Its Ohio-based North Star mill stands to gain from reduced import competition and improved margins.
These latest tariff and obviously the ongoing geopolitical tensions, how are they flowing through to the commodity markets?
So tariff hikes and geopolitical tensions are fueling volatility across commodity markets. Gold prices have climbed to $3,305 per ounce, driven by safe haven demand amid escalating trade and geopolitical concerns. All prices have risen approximately 3%, despite OPEC announcing a significant production increase as geopolitical risks overshadow supply expectations. Geopolitical tensions including the ongoing conflict in Ukraine, and trade disputes are exacerbating supply chain disruptions, impacting commodity flows and pricing.
Robert, on the market, there seems to be a big merger in the news, a $14 billion merger, Soul Patts and Brickworks. What do you know about it, and just how significant is it?
So Soul Patts and Brickworks have announced a $14 billion merger, concluding a 56-year cross-shareholding arrangement. Topco will combine Soul Patts investments with Brickworks building materials and property businesses for a greater scale. The merger unlocks around about $1 billion in value, boosts liquidity, and offers a broader investment opportunity set. Soul Patts holders get 1 Topco share. Brickworks holders get 0.82 Topco shares. a 10% premium. The merger is subject to shareholder and regulatory approvals.
So when you're looking at the market today overall, which sectors are driving the moves and why?
Yeah, so the ASX 200 is down 0.2%, with sector performance mixed. The tech sectors and the supermarkets led the gains. In the retail space, Coles was up 1.3%. The big four banks are all in the red, with Westpac down 1.7%. The miners have steadily lost ground since the opening, with, selling in mineral resources down 6.5%. Overall, the market movements reflect investor responses to global trade developments and domestic economic indicators.
And finally, given with what we're seeing in the markets, what are you telling your clients at the moment, and are there any opportunities for them?
Yeah, sure. So we're seeing weaker consumer and business sentiment. These are what we call the soft numbers. The data is flashing caution, but it's not yet translating into hard data. Labour markets remain strong, global growth holds steady, and corporate earnings, particularly in the US with Q1 just coming to an end, have been solid so far. We are closely watching to see whether the soft sentiment data leads into a slowdown or if fundamentals will continue to hold up. We are telling our clients to remain invested, invest in strategies that are designed to benefit from these current volatile environments, like your long-short strategies, for example. In particular, they tend to perform well during these kinds of environments. Be more diversified. That's the other thing we're telling our clients, more diversified than usual, not overly concentrated in one particular investment style, and investing in alternative assets such as infrastructure and private equity.
That is Robert Talevski there from Activam. Don't forget, if you do enjoy the podcast, to give it a rating or review on Apple Podcasts and Spotify, and to click that subscribe button.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.